Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, January 16th, and today's theme is simple. Policy is the new earnings call.
And unlike earnings calls, policy comes with plot twists, vague timelines, and a comment section. Let's translate the headlines into what do I do with my money?
First story, Taiwan reaches a trade deal with the Trump administration. Tariffs on Taiwanese goods get lowered, and Taiwan pledges more U.S. chip factories. That's a policy for CAPEX swap, less friction at the border in exchange for more manufacturing onshore.
So it's like, I'll stop charging you a cover fee if you agree to host the party at my place, except the party is advanced chips, and the cleanup bill is billions.
Exactly. The finance behind it. Tariffs act like a tax on imported goods, which can squeeze margins or raise end prices. Lower tariffs reduce that pressure, but building factories shifts costs to capital spending, big upfront money, potential long-term strategic benefit.
For normal people, does this mean cheaper electronics, or just more press releases about resilience, while my laptop still costs a kidney?
Near term, prices won't magically drop, but it can reduce the risk of sudden price spikes from trade shocks. For investors, watch who benefits: chip equipment, construction, industrial supply chains, and any company whose margins were tariff sensitive.
Actionable move: if your portfolio is basically tech plus vibes, at least ask, am I accidentally betting on politicians staying consistent? Because that's a bold hobby.
Second story, markets wrap. Tech stock gains build again, lifting U.S. stock futures, while the small-cap rally eases. That's a leadership shift. Investors leaning back toward growth and mega-cap balance sheets instead of the everything rally in smaller names.
Small caps got tired. They're like, I sprinted for 2 weeks. I'd like a snack and a nap. Meanwhile, tech is doing that smug treadmill walk.
The simple version: small caps are more sensitive to borrowing costs and the domestic economy. Tech tends to trade on long-term cash flows and narrative momentum. When the market gets even slightly uncertain, money often concentrates in perceived quality.
So if you're a regular investor, do you rotate? Or do you just accept you're emotionally attached to whatever ticker hurt you most recently?
Practical take: don't chase the daily leader. Instead, check your concentration. If tech has run and now dominates your allocation, consider rebalancing back to your target weights. If you want small cap exposure, size it like a long-term bet, not a week-to-week mood.
Your portfolio shouldn't look like a playlist where every song is Tech Anthem Extended Mix. Diversity is not just for HR departments.
Third story, an arms supplier, CSG, is ushering in a wave of defense IPOs in Europe. Defense stocks have been hot, and now private companies may try to list to capture that demand. More supply of shares, more investor attention, and potentially more volatility.
Nothing says the sector is popular like, hello public markets, please pay for our growth. IPO season is basically companies saying, you like us? Prove it with liquidity.
Finance analogy: when a restaurant gets famous, they open new locations. Great for the brand, but it can dilute the exclusive waitlist effect. In markets, more listings can spread capital across more names and cool the top performers, at least temporarily.
Why it matters to normal people. Defense spending is jobs, manufacturing, and budgets. Also, if you own broad index funds, you already own some of this. So the question is risk, not just politics.
Action step: if you're tempted by a hot IPO theme, decide your rule before the roadshow hype. For example, I only buy after the first earnings report, or I only buy via diversified ETFs. That reduces the odds you become exit liquidity.
Last one. There's uncertainty from a proposed ban on buying single-family homes. The headline target is Wall Street landlords, but the article says family offices could get caught in the crosshairs too. So, housing policy meets portfolio policy.
The finance behind it: if you restrict a buyer category, you can reduce demand at the margin. That can change liquidity, pricing power for sellers, and rental supply incentives. But it can also create loopholes and shift activity to adjacent markets, like multifamily.
So if I'm trying to buy a home, is this finally my moment? Or will the market just invent a new creature called Totally Not a Fund LLC and keep it moving?
It's uncertain. If it's narrowly drafted and enforced, it could reduce investor competition in some neighborhoods. But rates, income growth, and housing supply still dominate affordability. For investors, real estate exposure isn't just REITs. Banks, insurers, and homebuilders all feel second-order effects.
Quick recap. Trade deal plus chip factories means supply chain strategy with a tariff coupon. Tech is leading again, while small caps catch their breath. Defense IPOs could bring more share supply and more hype. And housing policy may change who gets to bid on homes.
Your to-do list. 1. Rebalance if a recent winner has taken over your portfolio. 2. Write an IPO rule you can follow under excitement. 3. Identify where you're exposed to policy risk, tariffs, defense budgets, or housing rules, and size those bets intentionally.
And if you want homework that's actually useful, pick one holding and answer, what headline could hurt this? If the answer is, a politician sneezes, maybe don't make it 40% of your net worth.
That's it for BD Daily Finance News Podcast, your daily briefing on finance and investing. If this helped, subscribe, leave a quick rating, and comment which theme you want next. Tariffs, tech leadership, defense IPOs, or housing policy.
And share it with a friend who says, I don't follow the news, but somehow knows every market move within 3 minutes. See you tomorrow.